What if there was a way to use property and invest in property to then essentially make tax-free money, which you can actually retire on? In this video, I'm going to discuss how that works and when you should use it. So you hear a lot of real estate investors and they talk about equity, and what is equity? Now we need to define what that is in order for us to understand how we can actually use it. And if you stick all the way to the end, I'm going to share with you how I use equity and what my plans are for in terms of an exit strategy outside of property. Now, if you are interested in a more detailed video about my exit strategy and what other exit strategies exist, then definitely leave me a comment down below. I'd love to make that video for you guys. Home equity is the market value of a homeowner's unencumbered interest in their real property. That is the difference between their home's fair market value and the outstanding balance of loan on that property. So in order for us to really understand what that means, I'm going to break it down in a very simple example. So let's say we purchase a property that's worth $300,000, and let's say we've been paying down the loan, or the property's grown in value, and so now our current loan balance is actually $200,000. Now, $200,000 is the loan, and the market value of that property, or the bank valuation that comes in, is actually $300,000. So what we would do is $200,000 divided by $300,000, which would give us 66%. Now that's our LVR. Now this concept that I talk about with LVR, LMIs and things like that, if you are interested in a more detailed explanation of this, there's a complete module in the course, Confusion to Clarity, which you can access in the link in the description below. But essentially, most banks are actually happy to lend out 90% of the home value. So in this case, if we were investing and we were, say, wanting to use the equity out of that property to then purchase more properties, we would go to the bank and say,
well, look, hi, Mr. Bank person. My property is now valued for $300,000, which they will obviously have a valuer conduct the valuation, and they'll come back and let's say it is $300,000.
Your current loan balance is $200,000, which means your LVR is 66%. We know that the bank is happy to give us 90%, and of course we have to pay some LMI, but if we want, we could even go to 80% and not have to pay LMI. However, if we do go up to 90%, well, the bank will go,
no problems, we'll give you 90%.
Now 90% of $300,000 is $270,000. So if we're trying to figure out our equity position is $300,000 minus $270,000. So in order for us to find what our real equity available is all we have to do is market value minus the loan, which would mean $300,000 minus $200,000, and that would give us equity of $100,000. Now, most people get this wrong because they think,
well, that's equity I can use.
That means
I can go out into the bank and say,
I want the $100,000 and then I can use that to do whatever else.
Now, most banks, I don't know any that would, actually give you a loan for 100% LVR, meaning that the value of the property is $300,000 and they go, well, you don't have to put any money down and we'll give you $300,000. That would make it 100% leveraged against the loan. So they're not going to do that. The maximum they'll go is probably about 90%. So we can't actually use the 100K. That's not usable equity. It's still equity, that's home equity, but it's not usable equity. And this is the part that most people get wrong. So what I mean by usable equity is the bank's ready to give us 90% of the market value. So in this case, if the property is worth $300,000, then 90% of that would be $270,000, which means $270,000 is the maximum they would allow us to borrow against that property. And if our current loan balance is $200,000 and the loan amount that they're willing to give us is $270,000, well, all we have to do is $270,000 minus $200,000 gives us $70,000 of usable equity. Now, if you are confused, you're not alone. This is a difficult conversation or concept to actually understand. Most people still don't get it. And if you do want to get a deep dive into what that means and how to use and work that out with a formula, in the link in the description below, Confusion to Clarity, I plug it everywhere. But the truth is, there's so much value on that in one place. You can go from start to finish very quickly. So be sure to check that out. So now that we know how usable equity is worked out and we know how the banks view these properties, how do we use this to our advantage so that we can leverage and use that money to then create a scalable portfolio? This is exactly what I've done, and I'll link a video probably up here somewhere that pops up where I reveal exactly what my property portfolio looks like and what passive income I generate from it. The truth is that this process does take time. Now, unfortunately, too many people jump into property where they think it's a quick flip game, where I can go in, property prices are moving so quickly, I could go in and in 3 to 6 months take out the equity and purchase again. Now, the truth is that if you're in a market that's pretty cold, it's sitting at 6 o'clock on the property clock and there's nothing really happening, it's not going to happen, right? Unless you go in and you can manufacture equity by, putting new renovations in, or you bought under market value because you understood the situation. For example, if you were able to go into a property and say purchase it because you had a really good relationship with the agent and they told you that, hey, look, the vendors are really, really desperate to sell because they've actually committed themselves somewhere else, because maybe they bought a new house and now they really want to offload this. We know the true value is probably around that 300K mark, but they might be willing to go a little bit lower if you have favorable negotiations and agreements and terms. This is where we can take advantage, right? And we've done this numerous times for clients and for myself, where we're able to go in and purchase under market value. Now, the truth is, if you're in a market like we are right now, properties are getting snapped up very quickly. And it's not that we are going into a property and taking our time with it, it's just the fact that there's so much competition right now. It really does mean that if an agent hears you offering anything less than that listed price, or at least something ridiculous, which is what we used to do, they're pretty much going to say,
piss off.
The truth is, if they're getting 25 to 40 offers on the same property, why are they going to sell it to you for $30,000 or $40,000 cheaper? Because we need to remember here, it's all well and good, we've got agent relationships and the agent wants to do business with you, but at the end of the day, I don't pay them. The vendor pays them, and the vendor is their client. So if the vendor, being their client, actually goes, well,
no, I'm not ready to settle quickly, I'm not in a rush, I just want to see what the market's like.
Or they may go, well,
Across the street, there was a house that sold for considerably larger amount than what I think my property's valued for. Let's try and get that property. Let's try and get that property price, and
I don't see why not.
now there's obviously a lack of education there because they might have different things in their house, the squares, in terms of how big the house is, plus the land size could be different. But that's the nature of the market we're in right now. So that's where you can't really go in and try and buy something under market value by 15, 20%, which means effectively you could go and get it revalued and take out the equity to purchase again. So what's more likely to happen in this market is that we're going to purchase property, and for the next 6 to 12 to 18 months, we're going to let the market do its thing. Now, if you've purchased in a really good area where there's a lot of competition, but as well as that supply and demand constraint that I've been talking about in previous videos, then you will make a considerable amount of equity in that property. So for example, let's say we do make about $30,000 or $40,000 of equity in that first property purchase. 6 months later, we can actually go in and get that revalued. Now, once it gets revalued, and let's say we purchase for 300, but now it's actually worth 330,000, well, now the bank will lend us 80 or 90% of the new value. So in the original example I gave you, where say it was $300,000 as the market value, our loan amount that we took out was 200K, and now we've brought it all the way back up because we've got usable equity. If now the property value is now $330,000, well, we would be able to borrow $330,000 times 90% being our LVR, and that will give us the new loan amount. And we do it the same way to figure out the exact number. We just figure out what that value looks like and minusing our existing loan on the property. So that would be our next available equity that we can pull out and then purchase property with that again. So what does this all mean if we're just trying to buy one property and taking baby steps in this? The fact is that that position that we have within that property is usable. So what we would do is if we said, go into a bank and say, look,
We want to take out that equity.
that equity would come across like an equity loan, or it could sit there in just an offset account against your property itself. So in that case, you could actually use that money for a range of things. You could go out there and renovate your property. You could use that amount of equity and then purchase another property. So that would effectively substitute your normal deposit that you would save as part of your cash from your job and things like that. So you can see how quickly it can move once you have a property portfolio. Because let's say you do have a property portfolio of say $1 million, right? Now, 10% on $1 million is $100,000. So if every year you had 10% of growth, you would have $100,000 compounding growth in terms of equity available to you every single year. And therein lies how you access tax-free money, because essentially you don't have to pay tax on this money. Now, of course, I'm not giving you financial advice. You should seek a financial expert or accountant to really talk you through this. But essentially, you can go in there and use the difference in equity and be able to pull that out and then be able to use that for your daily expenses throughout the year. Now, a lot of people actually have been using this over the last 5, 10, 15, 20 years because it was readily available and not many questions were really asked by the banks. Now, they've become a bit different with the regulations and how they ask questions, but it's definitely still possible. That as an exit strategy would mean that you would continue to increase your debt every single year because you're now using that money, right? Obviously, it's on the hope that the properties that you have continue to grow in value. The truth is, I would never do this, right? I would never use this strategy because as much as I love debt and I know the advantages of leverage, this would be the exit strategy. And for me, it doesn't sit well because some people go, well, if I've got like $1 million worth of assets and it continues to grow up by, say 10% a year, I have access to $100,000 tax-free. That's amazing. I could use that money and use it to purchase whatever I like. However, what happens if the properties don't go up in value that year? Or how, if interest rates actually do go up, which I foresee happening at some point in the next 10, 15, 20 years, it doesn't really look like you have much control over that situation. And for me, I've always said it on the channel, is that right now when I'm working, when I'm active, I can actually go out there, invest and buy up what I can because that's what I want to do. I have the choice to do it. Now, in 20, 30 years' time, I don't know what my situation looks like. Am I fit and am I able to do it? Have I lost interest in what I do? Well, we don't know. Maybe there's family, maybe I'm taking care of kids. And so at that point, I want to have as much control as possible, not be relying on,
Hey, the properties need to go up in value.
and I also need to satisfy with the bank that my income's high enough to service the extra loan amount that I'm going to get as part of the equity. So if you were looking at more of a tax-free money option as an exit strategy, yeah, sure, you could go down that path. And, there is obviously cons to it because you have less control, but it also relies on the fact that you go out there and you purchase real estate in really good locations that have continual demand. And that continual demand will increase and that equity growth increases as you go through those cycles. However, for me, I like to have control, especially when I'm looking at my exit strategy and I want to retire my debt. Of course, if you are interested in a more detailed example of, my case study of what I look at in terms of an exit strategy, then definitely leave me a comment down below. I'd love to make that video. I'm hoping this has definitely helped you in trying to understand a concept that so many still don't get. And I'm not saying that you're one of them, but hopefully this video has allowed you to see not only how one property can allow you to purchase another one, but how you can actually get a really good process. And that process allows you to build a scalable portfolio. At the end of the day, all of these things are just financial instruments. I don't simply sit there and go,
Oh my God, look at my properties. I'm so emotionally attached to them.
I simply do not care. At the end of the day, they are just like I would view particular cryptocurrency or a particular Pokemon card. At the end of the day, they are all just financial instruments getting me to my end goal, which is more financial choice and financial independence. If you have enjoyed this content, definitely leave me a thumbs up for the video. It goes a long way into pushing it out on the YouTube algorithm, as well as subscribe to the channel because there are a portion of you that haven't, and I would really appreciate it because that is, at the end of the day, my oxygen to keep making videos like this and helping people at scale. I'll catch you guys in the next video. Thanks, guys.